Hello, this is Richard Wilson, founder of the Family Office Club and Family Office Podcast. And I'm here today with SL from Caprock Real Estate. And I love talking about niche focused businesses, niche focused investments, and also things that are kind of going against a trend or a common belief and kind of bucking that and going the opposite direction. And that's what we're going to be talking about today, which is retail, commercial real estate investing, and a special type of retail opportunities within that niche. So, welcome to the podcast here, SL.
Thank you, Richard. It's good to join you.
And before we jump into it, can you share a little bit on your background and history and what led you on this path to now focusing on this niche?
Sure. It's a rather long path, but I'll summarize it. I have an accounting degree, so I am a CPA. I did work as an auditor for a little under 3 years, but had a real estate client that I was an auditor on and got a headhunting call for a new private equity firm that was specializing in real estate, and jumped at it because I knew long term I wanted to be in real estate and I didn't want to be an accountant. Accountants look at the past and real estate looks at the future. So that was my appeal to it. So I worked for an office developer. I started my first company when I was 29 doing syndications of neighborhood properties in the Lincoln Park neighborhood of Chicago, which is where I live. And then I worked for a family office managing their industrial portfolio. We had 1.5 million square feet office warehouse during the 90s, and I successfully turned around the portfolio and left when it was 98% leased. In the 2000s, I had a partner that we worked on disposing of excess real estate for institutions. So nonprofits like an Art Institute of Chicago or the Boy Scouts or different colleges like Loyola and DePaul. And then it sold out in 2006, good timing as it turns out. And once the crash hit, I decided I wanted to work on distressed real estate and started a firm with my partner at the end of 2008 and ended up working on distressed CMBS loans, collateralized mortgage-backed securities for what they call special servicers that manage the distressed assets, and worked. I would get a court-appointed receiver and work it out, raise the value, and then sell it. And we did that through the recovery, and then more recently focused on third-party investors that buy property in the Chicago area or the Midwest, but are generally from the coast, and they're attracted to the Midwest because our cap rates are so much higher. There's a nice spread that they can make with their, moving their money here versus what they can get in, say, California or New York, New Jersey, places like that. So, and then the last couple of years, I've focused on acquisitions and investments and developed an approach, and that's where I'm at.
Great. And so let's talk about that approach. A lot of it plays off of kind of a retail meltdown, retail apocalypse. People talk about how Amazon's putting everyone out of business that has a retail storefront, but that's not entirely true, and that's the niche you play in, right?
Exactly. So yeah, let's just talk about the retail apocalypse a little bit. It's kind of an overused term. The press loved it for quite a while, and at the time, 3-4 years ago, it was a dark time for a lot of real estate properties, mostly malls and power centers, and poorly located properties. During the good times, people could build anything, anywhere, and it pretty much would lease up and perform. But Amazon, as you mentioned, did have an impact on all retail, not just the malls where they devastated them. But even in the neighborhood properties where the tenants, the prices got squeezed because Amazon lowered prices on everything and they weren't strong enough to survive. But we've been through that process, and what I see is an arbitrage situation where we have for a period of time here, I'm not sure how long, where because of the retail apocalypse conversation, a lot of people just write off real estate, retail real estate, and look at it as, bad news. So they're staying away. So the volume of transactions and the competition for properties has declined, which creates an opportunity for me to pick up properties at better cost per foot and yield than I would have a few years ago. And I think that's going to continue at least for a few more years as we work through the next phase of the economic recovery. So
Right.
my contrarian view is that you stay away from what we call big boxes, which malls are big boxes, but also even power centers that are reliant on, large companies renting 50,000 foot spaces or whatever, that when they leave or go broke or whatever, you're stuck with a space that's really hard to reuse. People are putting churches in them, and fitness centers can fit, and trampolines, and there are some uses, usually, but it's really difficult to get all your space leased if you have too much of that. So I stay away from those properties, and I focus more on grocery anchored centers, which the grocers, create a lot of traffic for the other tenants, and they're quite resilient, except that I'm careful about really looking at the strength of the grocery store in that particular market. I want to be, I want to know that they're at least in the top three, because there is going to be a shakeout. There has been a little bit of one. There is going to be a shakeout in groceries, primarily because so many new grocery lines were started in the last 10 years, but also obviously Amazon's entered that arena. No one's quite sure what they're going to do, but you can be sure, and it already has happened at Whole Foods, prices are lower. So they definitely will push the pricing to get market share. I mean, that's something they're very good at. So then I also really like neighborhood centers where they're pretty straightforward. They have a fitness, they have food, they have entertainment, they have medical. A lot of different medical uses have found that retail is a great place to be versus an office building. Two reasons. One, they're closer to their customer. And two, when they're in an office building, unless they're really good at marketing or they're attached to a hospital, no one knows they're there. So this way, every time someone drives by, they see, Joe's Dental sign on the space, and they know, okay, there's a dentist. That works well. And lastly, are services that, it could be a product, but more likely it's a service, so that it's something that you can't put in a box and ship. It's something you have to go there to get or do. And so that's where we get what I call Amazon resistant tenants. And that I think is not going to go away. You're still going to need to go to a hair salon or a nails or whatever, because Amazon, I don't think will figure out how to do that in a box. So that's our niche. And traditionally, retail has traded at higher yields than the other product types like office and industrial and multifamily. But even now, there's even a greater spread, and so it's even more attractive.
Sure. What's the minimum cap rate that you consider when going into a property, and what are you typically seeing? What's a high cap rate in your space, in the Midwest, if that's where you're investing?
Okay, so on average, nationally, Class A and B spaces, which are the only ones you'd want to consider, because C means it's probably really old and really functionally obsolete, and someone should knock it down or use it for something else. So if you look at those cap rates, On average, nationally, it's between 7 and 7.5%, depending on who you're talking to. My numbers are based on CBRE and Reese numbers. On a high quality, new construction, Class A, credit tenants, you can go down to a 6 cap. I don't like to buy at that level. I like to have, maybe there's some vacancy or some reason that I can buy it at a 6 or a 6.5, but I lease up the vacant space and now I have a 7 or better. I try to have 7 as my bottom line. Like the property that I'm currently working on, it's 137,000 feet. It's sort of a lifestyle center in the sense that it has a theater, it has office space on the second floor, and then all your, good Amazon resistant uses from restaurants, services, Starbucks, things like that. And I'm buying that at an 8 cap, which I'm thrilled at. And I was able to do it in part because it's not a straightforward deal because it has mixed uses. Institutions are afraid of theaters right now. And I think in this particular situation, it's well positioned, it's not too big, and it provides traffic to the center. And they're at a low enough rent, I'm not worried that they're not going to be able to perform and stay healthy. So I've seen deals at 9%, occasionally at 10, but usually there's a problem with them if it's that high. So between 7 and 9 is sort of the range that I see good deals at that will perform and obviously provide a very good yield. Once you put some debt on it, you're in the low double digits, actually cash on cash returns, which is phenomenal. When you compare that to where bonds and interest rates are today.
Right. Some people might hear 9% cap rate and say, wow, it sounds unreal. It sounds so good. They might say, oh, well, it's probably a very, very small size deal. I mean, what are the smallest size deals you look at, and what are the typical size in terms of a check size or a price of the property?
Well, I do find really nice properties under 5 million that are attractive and have the credit tenants, and usually the Class A smaller properties that have a really good lineup of tenants. I like more to be in the 10 million to 15 million or 20 because the field of buyers is smaller. For 2 reasons. One, it's too big for a large part of the pool. They just don't have enough money to buy a property that big. And from an institutional standpoint, those are still considered relatively small deals. So a lot of them, have minimums that put them out of the game. So it's a smaller field overall, ultimately, of buyers. They're more entrepreneurial like me. Let's have access to capital sources that can write checks, 8 million or 10 million or 12 million, whatever. So that's where I play.
Sure, it makes sense. And how do you structure your deals? Are you raising funds? Are you doing as an independent sponsor, a deal by deal? Are you offering both options? What have you decided on, and how did you get to that thinking?
Right. I first of all, I'm flexible. It depends on the deal and depends on what the equity markets are like at that particular time. My overall preference is to do the more classic joint venture approach where you have 1 or maybe 2 equity sources, and then obviously I'm in as sponsor, and we have people that have the same views as I do as far as their approach, so how long they want to hold it. And things like that. So you have less partners then, the traditional limited partnership with, 20 people each putting in, a few $100,000 is another way to go. And some properties that is the way to go because the guys with more money aren't interested in that deal because it's small or, some other reason. So I do both ways, but I always put in 5 to 10% to put my money beside the investor, and then obviously manage it and work the business plan to achieve the end result we're looking for.
Sure, sure. And a lot of sponsors have, 6 to 8% preferred returns, and then they're, taking either 20 all the way up to 50% profit. Sometimes there's a couple of hurdles. What have you guys decided on for that approach, and how's the investor reception been to that?
Yeah, what I'm finding is people want it to be more simple. I think you see the multiple waterfalls on the more retailish kind of deals, where you have the smaller, less sophisticated investors, and you might have, 2 or 3 levels. But on the deals that I'm seeing where you have 1 or 2 partners and they're writing, big checks, they want a simpler structure. So let's say I'll say in the old days for me, you might start at a 80-20 split up to a 15% IRR, and then you go to a 70-30 up to 20 or 25 or through the rest of the cash. Where today, what happens is we pick an overall split that basically is all the profit above a 7, 8, or 9% average annual return, what we call the preferred return. But anything over that gets split 80-20, 75-25, something like that.
Sure, makes sense. Great. And then from all your experience in commercial real estate and real estate investing in general, for investors listening to this or commercial real estate investment firms, what's been one of the most expensive mistakes you've seen an investor make, or you've been on a team and the mistake was made, or you almost made the mistake and it was something you could share with the audience here to kind of have them learn from it?
Well, the biggest mistake is a misfit between the sponsor and the investor, where they don't have shared values, and the sponsor wants to go in one direction and the investor doesn't. And typical deals today will have a list of major decisions that the investor has a say in, virtually veto power, like a sale or refinancing or things like that. And that's evolved because, investors have gotten in situations where they discover that they don't see eye to eye with the sponsor. The next biggest mistake is the investment you don't make, or the investor you make, that are actually, there's fundamental reasons why you shouldn't have been there in the first place. I've been fortunate that I haven't had that problem, but
right.
It's inevitable. So
right.
You just have to be alert for. So, and
Sure.
and the biggest mistake I've made in my career was not buying properties in 2009 while I was doing all the distress workouts. I should have been buying at the same time, but that's all water under the bridge.
Sure. What about the most powerful insight? It could be on due diligence for private investors listening to this who are doing their own deals. It could be for evaluating the credibility and the professionalism of a sponsor, and maybe a family office or investor listening to this could really benefit from it, or just some other piece of advice you want to get across on the podcast that you think would be the most helpful thing to kind of end with here.
Well, to your question, and again, it sort of feeds my theme about the sponsor and the investor really taking the time to get to know each other and understand the each party's objectives. Is due diligence is really important, not just on the real estate, but on each other. So you understand them better, and most savvy investors now do due diligence on the sponsor. They don't just take your word for it. They really do lift the hood and look under it and see that it really is what you say it is. So it's something that everybody should be doing. As an investor, you need to do enough homework to understand what you're investing in, no different than buying stocks and at least understanding what Amazon's business model is and what the trends are. It's the same thing for real estate.
Right. Right. Yeah. Makes sense. So I guess I have one extra question I'm just curious about. In your space, are there a lot of investment firms fighting over the deal flow? Let's say if it's a $2 to $5 million deal or a $2 to $10 million deal in the Midwest, are you really in bidding wars, or is it just one or two other people at the table and don't even know if they're real?
So it's a bifurcated world. The better the property and the larger the size, the more likely that the seller has hired one of the more sophisticated brokerage firms. And their model is that they put it on the market. They give potential buyers enough time to do a high level of due diligence, 30,000 feet kind of stuff, and come up with a value. And then they do what they call a call for offers, and everybody submits their bids at this deadline. And then they play off, the top, they pick a top three, let's say, or five, and then they come back and say, give us your best number. They keep working you over. And it's sort of more like a sealed bid approach, because you, as a buyer, don't have that conversation going with the seller to really understand where their head is at as far as the value they're seeking.
Right.
And again, the number of bidders, I haven't seen any deals that I'm aware of that there were more than a dozen. In this deal that I have tied up right now, there were probably five, and we were in the top four, then the top three, and then we made it to number one through the steps that they put us through. So that's the range. I mean, it's really rare that you're going to get more than a dozen bidders at the end of the day.
Sure. Okay. And I guess one thing I just want to emphasize before we end here, and I'll give you a chance to add anything else you want to add, it's just that at our events, at the Family Office Club events, there are a lot of multifamily apartment building sponsors, which is fine because there's big demand for it. There's big appetite. But to survive in such a crowded space, you need to have a really niche or specific sharpened strategy or something that's unique or counter trend within the multifamily space to really survive, in my opinion. You see office park and self-storage next. Every once in a while, see a RV park, a mobile home park, or maybe retail. And only twice I've seen industrial real estate sponsors at our events over 12 years. So it's really one of the less, popular areas that you're in right now. And I think you're going to do well just because it's not overly crowded, but it has to lead to some educational challenges. I'm guessing you have to maybe, bring investors to some properties, show them the types of returns, and spend more time educating than somebody in self-storage or multifamily might need to, right?
Exactly. And part of my approach to that is getting published, doing podcasts, speaking at events. Appreciate the opportunity I had in Dallas to speak to your group there, and share these materials. They're on my website, but I share them with prospective investors who may be very experienced with one of the other property types, but are curious about retail because they see that they can get a higher yield. And then after, talking to me, they either buy my pitch or not, as to what's really going on in retail and why you can make money without taking extreme amounts of risk. So it's if I were doing multifamily or warehouse, there's nothing to tell. That people already know everything about it. It's been so popular for so long that the real challenge is everything is, I think overpriced, but highly priced and very low yields for the investors. So, it's popular, but I think they're shorting themselves in not getting the higher yield that real estate can deliver without taking, a lot of extra risk. So,
Sure. Okay. Any last comments you want to make or points you wanted to get across that we didn't have a chance to talk about yet?
well, I wanted to talk a minute about what's happening today. So,
Mhm.
as evidence that retail is an apocalypse, is the retail sales in the United States continue to increase despite all of the talk and the noise and the tragedy that happens at some properties. Uh, this year, it's projected to be between 3.5% and 4.5%, which on an economy this big, it's really impressive. So each quarter, each month, the sales numbers come out and they're still positive and still growing at a nice rate. So as a further assurance that that retail is a good sector, I wanted to point to that. Secondly, I wanted to talk about a vision of what I see happening in retail, and I don't know how quickly this will come, but
Sure.
Jeff Bezos, who is an incredible competitive player in the e-commerce arena, is focused intensely on same day or 1 day delivery. Like in urban areas like Chicago, a lot of the stuff that isn't too bulky and is in high demand, I can get the same day that I order it. It might be 9 o'clock at night when I get it, but it will be the same day, and at no extra cost for that, because as a Prime member, you don't pay for that. What he's done in the last couple of years is figure out how to build a delivery system of his own. You may be aware that he cut ties with FedEx. I think it was earlier this year or late last year, and everybody was scratching their heads. Well, that's because he has his own planes, he has his own delivery system that he's building and expanding. But his stated goal is to have all deliveries within 1 day. And you go, why spend all that money and work that hard to deliver it in 1 day when people are happy with 2 day delivery or whatever at this point?
Sure.
And most, other than Amazon, most places you order stuff, it can take a week or whatever. And I think, this is my theory. My theory is that if he can consistently deliver in 1 day, think about the convenience of ordering it versus going to the store. You're going to go to the store when you need it immediately, right? But
Right.
if you needed your new type, stapler or whatever, you can wait till tomorrow, right? So, and you look at who are the top two retailers, and it's Walmart and Amazon. And Walmart right now, last year they grossed 500 billion, and Amazon grossed 250 billion.
Mm-hmm.
And Walmart's been a pretty robust both e-commerce and bricks and mortar retailer, and they have been at it a long time. But they're also Walmart is a price sensitive retailer, just like Amazon. And I think his plan is to make it so convenient and have it as such a tight system that other retailers won't be able to compete with them without building their own. And he will have done it while they've been all looking the other way, and he'll just kill them. I mean, it's that whole relationship could flip, in short order once he can prove that model. So I haven't talked to him. He hasn't told me that's his plan, but that's when you extrapolate what's happening. That's what I think is going to be the next big event in e-commerce and retailing.
Right. Yeah. Interesting. I've seen that Amazon has some stores they're opening within malls. I've seen them before myself, and that's interesting that they're going into retail themselves, where they see maximum foot traffic, perhaps. So I don't know if you've seen that trend.
Yes, it's something I failed to mention. So this is really interesting. So you take an online retailer like Warby Parker, eyeglasses, or other outfits that started totally as e-commerce outfits. They're one of the hottest new growth areas for owners of retail real estate, to land them as tenants. They pay good rent. They obviously have good credit. They already have a successful business plan. And by opening that store, the physical store where people could come in and touch and feel, and I wear Warby Parker glasses because they're really cost effective. And I was able to go to a store here in Chicago. They have several now, and try them on and look at them in the mirror versus on an app on your iPhone. And it works. Well, companies that have transitioned to be both e-commerce and bricks and mortar, their sales go up on average like 35%. It's been a home run for the people who've done it. Amazon sees the same thing. I have an Amazon to go store across the street from my office, and this, I don't know if you've seen this or not yet, but there's no staff. There is a person there, and they're teaching people how to do it. But you go in, you pick up the items, and and when you go back through the turnstile, it adds it up and charges your Apple Pay account. And they have a vision of, this is just food, and convenience kind of stuff. But they have a vision for doing bigger stores that do more stuff, and that are cashierless. So they're definitely going to be a player in bricks and mortar, which is a great thing for us. You can go and you can touch it, and you can get service, return items, pick up items. UPS just started, our UPS store in our neighborhood strip won't take packages anymore for drop off. They send you to a little contraption next to the 7-Eleven where you scan the box, and it opens a little door into like a mailbox, and you put it in there, and it goes on from there. And it's easier for UPS to do that than making the trips to all the different drop-off points. Very intriguing.
Makes sense. Yeah, I mean, it's the ultimate Amazon immune retail is an Amazon store, I guess, huh?
Right.
Yeah,
everything goes full circle.
Yeah, well, we operate our family office club business in a retail center in a wealthy community, just because of the reason you talked about with the dentist. So when people go by, they see where we are, and they can walk on in. And we've had a billionaire come in their baby stroller. We've had private equity fund executives, CPAs of family offices, wealth advisors, and definitely helps. So I see that as a really relevant trend that you mentioned earlier as well. So just to close it off, where's the best place where somebody can learn more about USL and Caprock in general, in terms of a website address or somewhere like?
Yeah, so the web address is relatively simple. It's Caprock, it's CAPROCKRE, meaning realestate.com. And it covers everything we do. It's also somewhat educational, and we have a chat feature, and once we get connected, we can take the conversation from there. So
great.
That's the best way.
Excellent. Well, I'm looking forward to seeing you at the Family Office Super Summit, and hopefully some of our events in 2020. If anyone's not signed up yet, please check out familyoffices.com/super. It's going to be at the Ritz-Carlton here in Key Biscayne, just outside of Miami. And thanks for your thoughts here, SL. I hope to have you on the podcast again sometime.
Okay. Thank you. I'd love it.
Take care.
So, Richard,